Hello, everybody, and welcome. Thank you so much for joining me here today. I'm glad to have you. We are going to be taking a look together here at the markets, what's happened, and talk about what this can mean for your family and your wealth in the coming months. Now, my goal is to cut through some of the noise and focus on what really matters to you as investors. So, I have my iced coffee here. I hope you have something good to sip on, and we're going to jump in. Now, here's today's key talking points. We're going to be discussing several market moving topics and how they might impact your portfolio in the coming months. And so I want to dive right in with my first kind of main slide. This is really a market recap. So this is looking at key headlines from the last quarter. As you see, this is looking at the S&P 500 during Q3 rather, not Q2. That was in the past. We're in Q3 now. And it overlays major economic and political events. Here's the main takeaways. The S&P continued its steady rise over the past few months, building on Q2's rally from April's low. And so when we look forward, this quarter was noticeably less volatile than Q2. This is mainly because of trade policy uncertainty easing and the economy stabilizing to a degree, but it still included multiple major events. The quarter started with the passage of the One Big Beautiful Bill Act. You may have seen me do a video about that separately. And as we've dove through that, there's some really key things that are going to impact retirees. It's also having an impact on the business cycle as well, because the Trump administration was able to continue that tax legislation that they had, so that this was extended from the 2017 tax cuts. Now, this was passed by the prior Trump administration. And so you had a Trump administration, then you had the Biden era. Now we're back in the second Trump administration time. Now, after Congress passed the tax bill in the first week of July, the market's focus really shifted, and it shifted to more outstanding themes. These are things like the Federal Reserve policy, the build out of the AI industry, and trade policy. Now, debate around Fed policy and the economy really dominated the quarter, and that was driven around labor markets as well as inflation concerns being the main areas of focus. On the inflation front, there were multiple reports showing price pressures on tariff sensitive goods. These are things like furniture and apparel. However, the broader impact actually was relatively smaller than expected. And so, because of that, it was relatively contained. And that helped ease concerns around some of the inflation risk. Meanwhile, labor data came out and that softened, and unemployment rose as monthly job growth slowed. So while the Fed was previously worried about tariffs reigniting inflation, that concern now appears more misplaced as labor data has softened. So after a 9-month pause, the Fed made the decision to resume its rate cutting cycle in September. So the S&P 500 ended the quarter near its all-time high, despite mixed signals from the economy. There's been a mix of factors and themes that supported the rally during the quarter. The Fed's decision to resume its rate cutting cycle provided interest rate relief to borrowers. We also saw reinforced expectations for a soft landing. Q2 earnings beat expectations after estimates were revised lower throughout the quarter. This was due again primarily due to the concerns around tariffs and an economic uncertainty. And then AI related capex continued to fuel really strong earnings growth for mega cap stocks. And it really drove a lot of the economic growth. Now, we're going to discuss each of these major themes in this webinar in a little bit more detail. So I'm excited to keep going. Also, I just want to say this. As you look through here, some of these themes are gonna jump out to different folks, but my goal is to give you kind of a broad overview. Keeping in mind, if you're in more of a dividend-driven portfolio, you're gonna have a little bit of a different expectation than somebody who's in a more tech-heavy portfolio. But we're talking kind of broad themes and how the market as a whole is running. So I hope everyone finds this interesting, at least almost as interesting as I do. So let's talk about the stock market. This was a quarter where small cap stocks outperformed large cap stocks. One of the big themes during the quarter was that Fed rate cut and its impact on various corners of the market. So this slide graphs the quarterly price return gap between large cap and small cap stocks. Positive readings indicate that small cap stocks outperformed. Negative readings indicate large cap stocks outperformed. So this chart shows that the small caps have consistently underperformed since early 2021, with small outperformings only in 5 of the last 19 quarters. So 3 themes here contributed to the performance gap. First, smaller companies' reliance on floating rate debt meant they were impacted more by the Fed's rate hikes. So, second, the smaller size left them with less pricing power as inflation led to rising output. And then third, these small cap stocks indices have limited exposure to the leading AI companies, which reported really strong earnings growth. So together, high interest rates, soaring inflation, and small caps AI underweight created a significant performance drag. This performance trend started to reverse in Q3 with small cap outperforming by 4%. So you'll notice when I was kind of saying that you have this ramp up for time and then you've seen this reversal in Q3. So it marks the small cap's biggest quarter of outperformance over large cap since Q1 of 2021. That was before the Fed started hiking rates. Inflation soared to a 4-decade high and the AI industry emerged. Two themes contributed to small caps outperformance in Q3. First, the Fed resumed its rate cutting cycle after a 9-month pause. The rate cuts are expected to provide interest rate relief to smaller companies, and the market is optimistic that those lower interest rates are going to help cushion the US economy from an economic slowdown. The second thing is those small cap stocks benefited from a catch up trade due to their steep valuation discount compared to large cap stocks. So everybody kind of looked at things and said, all right, that's going to drive it positive. It's on sale right now. And that really helped propel things up. So because of that, the Russell 2000 hit a record high in late Q3 after the Fed's September rate cut. And this is the first new high since late 2021. The market's really watching to see if this outperformance carries into Q4. I'm curious to see myself exactly what's going to develop over the next couple of weeks, particularly with the current market shutdown, or I'm sorry, the government shutdown that we're experiencing. And that's going to delay some of the reporting numbers that we're looking at, could have an impact on these small cap. But I think it's important to keep in mind, is this a temporary issue or is this a longer issue that's going to have more of a prolonged effect, or is this a short-term blip as far as trading and the amount of confidence that people feel? So the Fed's decision to resume its rate cutting cycle was the first step towards narrowing that performance gap. And again, this is something we're going to pay close attention to. So let's put the AI capex boom into perspective. So this is really focusing around the emergence of the AI industry, which was a key driver of large caps outperformance in recent years. I think everyone here recognizes NVIDIA. Even folks that aren't super tech savvy, everyone seems to know the name NVIDIA. Well, that's because of this AI impact. Now, the chart on the left, it's graphing investment in information processing equipment and software. This is a subset of quarterly GDP data. In Q2, tech investment grew 14% year over year, and this was the fastest pace since the late 1990s. During the dot-com era, an investment in computers and software grew 15% year over year. This was really because of those telecom companies investing heavily to lay fiber, construct cell towers, and build a lot of that physical backbone that created. It's really the backbone for the internet today. Now, today's surge is driven by AI, with leading tech companies investing billions of dollars in computer chips to train AI models, data centers to run the models, and new energy infrastructure to support it all. Now, the chart on the right shows how the current tech spending boom is impacting stock market returns. It compares the price return of the Magnificent Seven. Now, this includes the mega cap AI leaders NVIDIA, Microsoft, Amazon, and Meta against the broader S&P 500. Over the past 2 years, the Magnificent Seven has returned nearly 150% more than double than the S&P's 60% return. The catalyst is the AI company's strong growth, which has been driven by the tech spending boom. Now, it's difficult to overstate how much this AI capex cycle has impacted financial markets. The AI industry build out has powered both equity market returns and economic growth rather, as tech spending grows at the fastest pace in decades. The AI capex cycle has become a major macro theme, and that's also raising questions about what could happen if tech spending slows to more of a normal rate. So remember, some of this is driven by performance. A lot of this has been driven by that tech spending. And so then the question becomes, if that spending slows, what then? What impact are we going to have? So let's look at corporate earnings. Now, this provides a two-part snapshot of corporate earnings performance for S&P 500 companies. I know everyone's really excited about this. I hope you find this as interesting as I do, because the chart on the left is really graphing the percentage of S&P 500 companies that were beating earnings expectations each quarter. Over the past 5 years, an average of 78% of companies beat expectations each quarter. The percentage of companies beating earnings and were the highest in 2020 and 2021. And that was as the economy reopened, kind of following the pandemic, and expectations remained fairly low. The beat rate fell during 2022, and this was likely due to more tight financial conditions and economic headwinds from the Federal Reserve. This was really because they were raising interest rates to try and combat inflation. However, earnings performance really had a big rebound in 2023 and 2024, with the beat rate rising back to that long-term average. Now, there was a short dip in late 2024, early 2025. That was due to an expectation starting to outpace actual results, but that beat rate rebounded in Q2 2025 after analysis lowered estimates earlier in the year due to a little bit of that economic policy uncertainty. The key takeaway here is corporate earnings have remained surprisingly resilient, and that's despite tariffs and rising policy uncertainties. This also speaks, in my opinion, to the importance of investing in companies that have strong underlying values, and that you look at it and you can see that borne out in their earnings reports, not just on a quarter to quarter basis, but also kind of that larger trend of how's this company performing. Are they cutting their way to success, or are they actually performing well? Now, the chart on the right graphs earnings revision sentiment. Now, this measures the net percentage of S&P 500 companies with upward revisions. Revision sentiment spiked in recent months, and we saw a 1 month change of 24% and a 3 month average of 27%. Both of these readings rank in the top 10% of historical values, and this is highlighting a rare surge in Wall Street analysis optimism. You don't always see that. Wall Street, sometimes they're super optimistic. That would be more bullish. Other times they're really pessimistic. That would be more bearish. This level of like positive sentiment, this level of just kind of, hey, we can do it. This has not been seen very often. But when it has been seen, and this is an example of 2010, 2018, 2021, it's followed by periods of economic recovery or improved business conditions. Now, I can't promise you that previous always mean moving forward, but that is an encouraging sign. It's something to keep in mind. So these two charts really underscore the resilience of U.S. corporate earnings over the past 5 years. Despite macroeconomic challenges ranging from a really aggressive Fed policy, kind of rate hikes, to trade policy uncertainties, companies have consistently managed to outperform expectations. So the trend reinforces the strength and adaptability of corporate America. Just as an aside, as a patriot, as someone who loves our nation, if you're betting on any economy in the world, I feel you'd be remiss if you were betting against the US economy. I feel strongly in this nation. And when you look at this, you see the charts kind of bear that out. Now, as a result of what we've seen here with these trends, analysts are raising earnings estimates, and this is signaling a lot of confidence in both the economy and corporate profitability. Looking ahead, the question is whether companies continue to beat what is now a really high bar. So the other thing you have to keep in mind with that is sometimes when you get too confident, all of a sudden everyone goes, okay, you're going to crush it forever. And there may still be some ups and downs. So it's just a question of whether or not those companies can continue to beat that high bar. Now, let's talk corporate credit spreads. This slide is showing corporate credit spreads, and they are at levels not seen in decades. So the chart on the left is graphing whether investment grade corporate credit spreads, it measures how much more of a top rated company pays to borrow compared to the US government. The current spread is around 70 or 0.75%. BIP stands for basis points. And so 1 BIP would be 100th of a point. So 100 bips would be 1%. So 0.75 would be 75 bips. You may have heard that term kind of floated around. But that's a level that was last seen in 1998. Historically, the spread is closer to around 1.3%, a half a percentage point higher. When we're talking about a half of a percent, that doesn't sound like much. But when we're talking about going from 0.75 to 1.3, that half of a percent is a significant leap over. We're talking getting close to double. So the chart on the right shows high yield spreads are also tight, but they're not as extreme. The current high yield spread is around 2.75, and that's the tightest since 2027 and well below the median of 4.5 since 1996. Credit spreads stand out for how tight they are compared to history, with companies paying a smaller risk premium to borrow. So when you look at that risk premium, you have to think about why. Now, there's several factors that kind of explain this. First, yields remain high in absolute terms, and this is compared to the past decade, making corporate bonds attractive even with tight spreads. When you think about that half a percent, again, it both is and isn't a lot depending on your perspective. If you think about it compared to 0.75, well, that's a lot. But when you think about a return of 1.3 versus a return of 0.75, when it comes to your portfolio, that's not a substantive difference, right? So the second thing is corporate fundamentals are healthy with strong earnings growth, manageable debt loads, and high interest coverage ratios. By contrast, the market is concerned about whether the current trajectory of government finances in a reversal of roles, the government, not corporations, is paying a higher risk premium. Third, the Fed resumed its rate cutting cycle in September. And the market expects it to continue to cut interest rates into 2026. As a result, investors are moving in today to lock in today's yields. So while spreads are tight by historic standards, extreme valuations don't always correct quickly and often need a catalyst to normalize. What could shift the balance between risk and change the market's view? Here's a thought. Here's two different scenarios that stand out. First, an economic slowdown or decline in profit margins could cause the market to demand a higher risk premium, causing credit spreads to widen. Second, if companies take advantage of their tight spreads and borrow more, it'll increase the supply of corporate bonds. As an increase in supply, whether to fund mergers, stock buybacks, or other incentives, without a corresponding rise in investor demand, it could cause spreads to widen and bond prices to fall. So today's yields are compelling, but they come with really important trade-offs. Credit spreads are at a multi-decade low, and spreading when spreads are this tight, there's really less room for error. So for investors, that means understanding the risk, emphasizing quality, and maintaining diversified bond exposure. The market isn't signaling danger. I wouldn't say that this is a giant red warning sign screaming danger, danger, but it's not offering a margin of safety either. So when you look at this environment, it really pays to be disciplined and keep a long-term perspective. I think when you look at the interest rate environment and the bond portfolios, one thing I will say, and I didn't have this in the notes, but I thought I'd throw it in here and just kind of share it with you, is to keep in mind, why do we have what we have in the portfolio? And when we look at those risk premiums, does it still make sense? And so the bond market is an area that we've been paying close attention to. So let's talk about the labor market. Now, U.S. monthly job growth, this is charting it going back since early 2022. Now, the labor market was exceptionally strong in 2022, with job growth surging as the economy was reopening after the pandemic. So monthly job gains were strong throughout that year, and this was reflecting robust demand for workers. By late 2022, early 2023, the pace of hiring began to slow as the initial reopening boost faded, and the Fed's rate hikes were starting to weigh on the economic activity. While the pace in 2023 was still healthy by historic standards, it marked a slowdown from 2022. Again, you can't talk about 2022 without thinking about 2021, 2020, the pandemic, and everything that went on. So that was a bit of an unusual period of time. That's why you see back in February of 2022, it was so high, and same thing in June. But here's the thing. This slowdown became more pronounced in 2024, with monthly job growth becoming smaller and more irregular. There was a brief rebound in late 2024 after the election, and this was as reduced policy uncertainty kind of gave companies the confidence to proceed with their investments and their hiring plans. However, this growth was not sustained, and in recent months, the labor market appears to be stalling, with some months showing little to no net job growth. This gradual slowdown from 2022 mid 2024 indicates that the labor market lost momentum. This was possibly as higher interest rates and economic uncertainties started to weighing on hiring. The labor market often lags other economic data, so recent job losses might be reflecting things that have been building for several quarters. Regardless, this soft labor market has implications for workers, the economy, for policymakers, for workers and businesses. It's signaling a more cautious environment, fewer job openings, potentially more layoffs, and the potential for slower wage growth. For policymakers, the slowdown suggests monetary policy is too restrictive and that it may be time to lower interest rates. This is something that President Trump has been pushing for quite a bit. So let's talk about those interest rates. This slide is going to give you an update on Federal Reserve policy. It graphs the federal funds rate, which is the interest rate that the Fed raises and lowers to set monetary policy. So let's take a quick recap of the past couple years. The Fed cut interest rates. They went to near zero during the pandemic, and this was to support the economy. It kept them near zero until March of 2022 when it began raising interest rates in response to surging inflation. From March of 2022 to July of 2023, the central bank hiked rates by 5%. And this was one of the largest and fastest rate hike cycles steady in recent history. So when you look at it, it was like, this was quite a bit. It then held rates steady through 2024. That was through September of 2024. And it waited for inflation to return to that 2% target. Now, when we talk about that 2% target, there you have to keep in mind that the Fed has multiple mandates that they're looking at, and it feels like they were looking very heavily at that 2% target of inflation to maybe a little bit of an outsized degree, but that's neither here nor there. So let's talk about what they did in September of 2024. They started rate cutting again, and it cut interest rates by a total of about 1% over the next 3 meetings. But it paused that rate cutting cycle earlier this year due to concerns about an inflationary impact of tariffs. So after that 9-month pause, the central bank resumed its rate cutting cycle in September, and they did 0.25% rate cut. Now, policymakers cited soft signs of labor market softness, and that explained the decision. And they're pointing to slowing job growth, rising unemployment. In his press conference, the Fed Chair Powell framed the move as a risk management cut, and he described it as a proactive step to keep the economy expansions on track, and that was rather than concerns about recession. Looking ahead, the real question is going to be how much more will the Fed cut? The Fed's latest forecast shows 2 more 0.25% cuts this year, and then another 2 in 2026. Market's forecast is very similar. There's an expectation for additional rate cuts in the coming months and quarters. Now, how much the Fed actually ends up cutting is ultimately going to depend on the trajectory of both the economy, unemployment, and inflation. So there's a lot that goes into this as far as making that determination, and we'll see if everything kind of bears out the way they're indicating that it will right now. So let's talk about some mixed signals here. This is taking a closer look at the U.S. economy and the mixed signals that are complicating the Fed's job. So it's comparing headline GDP growth against core GDP growth. Headline GDP captures the full picture of economic output, and that's including consumer spending, that's including business investment, trade, etc., right? However, certain aspects of the economy are more volatile, and that can distort GDP. And this is things such as imports, exports, inventory stocking, and government spending. You can see this volatility in the red line, which fluctuates more. Core GDP, which is the gold bars, those exclude the volatile categories to provide a clearer view of underlying consumer and business demand. Starting on the left, economic growth was really strong in 2021 as the U.S. economy reopened after the pandemic. Growth started to slow in 2022 with both headline and core GDP falling. The timing of the slowdown coincided with a 4-decade high inflation, a stock market sell off, and the start of the Fed's aggressive rate hiking cycle, each of which likely weighed on the broader economic activity. However, I want to point this out. The chart also shows the economy rebounded sharply in 23 and 24, with both headline and core GDP rising. The data indicates that the economy started to adopt higher rates with robust customer spending and government spending leading to increased private investments. This year has seen an increase in economic volatility. Headline GDP growth was negative in Q1, and that was primarily due to companies front loading imports to beat tariffs and consumer slowing spending. So as consumers were a little bit concerned about tariffs, they slowed spending a little bit, keep a little bit more cash in their pocket. At the same time, companies said, hey, let's go ahead and maybe over order a little bit. Core GDP also weakened, with the combination indicating that economic activity weakened as trade policy led to increased uncertainty. Remember, the markets do not like uncertainty. We like clarity as far as what's going to happen. Now, however, both GDP measures rebounded sharply in Q2, reverting to their 2023 and their 2024 pace as trade policy uncertainty eased and the stock market ended up rallying to new highs. So, based on July and August data, the rebound appears to have carried forward into Q3. However, there's a sharp divide. Consumer spending is strong and AI capex is surging, but housing and non AI business investments are struggling under these higher interest rates. So, the Federal Reserve is trying to make sense of economic data as it determines what to do with the next interest rate cuts. We're going to see how they continue to handle it. Of course, they've been signaling that they're going to continue doing those rate cuts, but we're going to see where they end up landing. So this is going to highlight 3 market themes to watch over the next 6 months. So let's talk about AI capital expenditures, Q4 labor market data, and early impacts of rate cuts. So the first theme is the surge in those AI-related capital expenditures. As you look at the technology investments, they're growing at the fastest pace since the 90s. Many AI-related companies are reporting growing backlogs that extend out multiple years. Management team forecast is continued spending growth. Expectations are high, and investors are treating the AI capex boom as a multi-year investment cycle. The key question is whether or not the current pace of tech investment can be sustained. The answer is going to have implications for the stock market. It's going to have implications for the broader economy, as CapEx has powered the S&P 500 to new highs and contributed to that economic growth. Now, the second theme relates to the softening in the labor market. We already did a whole slide where we were talking a little bit about the labor market and kind of how it is. But as we discussed earlier, those job gains slowed in recent months, and the unemployment rate rose to its highest level since 2021. So there's a debate about whether the softness is a delayed response to tariffs and if it's policy uncertainty in Q2, or is this the start of a new labor market that's shifting tied to high interest rates and a cooling economy? So the softness caused the Fed to cut rates in Q3, and the market's going to be watching labor data very closely in Q4. If the softness continues, it could justify additional rate cuts to support the economy. Now, the third thing is the early impact of those rate cuts, and it relates to the Fed's recent rate cut. After a 9-month pause, the Fed's rate cut interest rates by 0.25% in September. The Fed and the market expects more rate cuts, and I've kind of been talking about this for a little while. The real key question is, how are lower interest rates going to impact the real economy? Housing and manufacturing data has been weak since the Fed started hiking interest rates back in 2022, and the market's going to be watching whether or not the cuts spur a rebound in activity or not. This economy's trajectory is going to be critical in really determining the Fed's next steps and shaping market expectations. So again, I think the Fed have laid out what they're planning on doing, but when we look back a couple of years, when they were starting to raise interest rates aggressively, they were really heavily raising interest rates. Nobody was shocked because they were very clear about what they were doing and why. Here, there's a little bit of murkiness where it's like, we're going this way, but we might be making adjustments. It's a little bit more up in the air as strong commitment to what they're going to be doing. So let's look at the long-term perspective. We've discussed a range of really important themes in these slides. I would highlight really the resilient corporate earnings, tight credit spreads, soft labor market data, mixed economic signals, and the rise of AI. It's been a really busy year for the markets, and Q4 is shaping up to be absolutely no different in that regard. This slide kind of zooms out to look at the big picture. So this chart is tracking the growth of $10,000 invested in large cap stocks and bonds from 1975 to today. So if you look here, you can see that this red line is showing you $10,000 invested in large cap stocks invested in 1975. Now it would grow to about $620,000. The light blue, or I'm sorry, rather the gold line here is showing you that same $10,000 invested in bonds, and it would have grown steadily. You definitely wouldn't have those big spikes and rises and falls, but it would have grown to about $200,000. So what I see here is really exemplifying the fact that stock can be volatile in the short term, but they've historically delivered the highest long-term returns and the strongest protections against inflation. I should probably point out here, when you look at inflation, that's more of a steady climb, but that gray shaded area is representing inflation. So you can see it here down at the bottom. So to maintain the same purchasing power as $10,000 in 1975, an investment would have had to have grown to be about $55,000 today. So this highlights the importance of thinking about things in inflation adjusted terms. Saving your money isn't enough. It's just not. Investments must grow faster than inflation in order to build wealth. If savings were kept in cash, that purchasing power would steadily decline. We're feeling the effects of inflation today. We've been in a period of high inflation, but I would say that when you look at this chart, yes, it's been an increase going back to 2020, but when you look at it, it's more of that steady climb all the way back to 1975. And I can show you charts showing inflation much further than that. So when I talk about beating inflation, it's not just a nice to have kind of thing. It is essential. I would argue it is key. So while stocks can be riskier in the short term and be impacted by a long list of economic and macro themes, they've historically they've historically rewarded investors rather with decades of economic compounding returns. That said, it's also important to consider your risk tolerance, investment horizon, retirement planning, and the role of diversification when building a portfolio. So I think it's really key to look at that bucket of money and say, okay, are these funds that I need to utilize in the near term, or can I handle some of that volatility? And these are positions that can be put into more of an equity driven or more of a stock driven portfolio and kind of handle that long term growth. I hope this has been interesting for you guys. I always enjoy doing these kinds of things. So if you have questions, you are welcome to email us. Just hit us up at info@semmax.com. You can give us a call. You can schedule time. And I will also tell you, we got some pretty cool definitions up here. They're always neat. I think it's important to understand why we use the terms that we use and what they are. But if anything I said confused you, give us a call. If there's anything in here where you say, you know what, that's a really interesting thing, I want to talk a little bit more about it, don't hesitate to reach out. I hope this has been beneficial for you. I hope you enjoyed this as much as I do. I love putting these things together, being able to talk with you about them. And I thank you for your time, and I hope you have a beautiful day. Thanks so much for watching.